Let's talk about risk management and trading psychology. There is one pitfall that so many traders are not taking seriously if they want to become successful in forex trading, and that pitfall is money management and psychology. If you don't know how to manage your money very well in forex trading, and if you don't have the right psychology, honestly speaking, you are not going to last long in the forex market. So that is why in today's video, I want to talk about risk management, money management, and trading psychology in forex trading. So if you want to be successful in the forex market, if you want to become a consistent, profitable forex trader, you need to pay clear attention, because what I'm going to be sharing with you in today's video is going to help you to become a professional forex trader. So please remove ego and pay clear attention to what I'm going to be sharing with you in this video. I have gone through a lot. I have made so many mistakes. I've blown so many accounts, and I have learned so many lessons from my past experience. And that is why I don't want you guys to go through the pain that I went through in the past. That is why I am sharing these tips with you guys, for you guys to take note. If you want to become successful in the forex market, you need to do what? You need to respect your risk management and your money management. These are the things that will trigger your psychology. If you don't know how to control your risk management and your money management, you will not be able to control your psychology, because forex trading is ability to control your emotions. It's not like every other job that demands only your IQ, your intelligence, right? Forex trading demands your discipline, right? It demands you to be able to control your emotions. So if you can be able to control your emotions, your greed, you'll be able to make money consistently in the forex market. I keep saying this in all my videos. Do not risk more than 1% or 2% in your trading capital. If you want to last long in the forex market, do not risk more than 1% or 2% of your trading account. There is one thing that most of you traders, especially the newbie, do not understand about forex trading. Forex trading is a game, right? It's a game of number. It is also a game of probability. The reason why so many traders are blowing their accounts most of the time is because they want to flip, right? You see them, they will have just $100 in their trading account, and they want to flip that $100 to maybe $1,000, and before you know it, they will blow the account. Or they have just $1,000 in their trading account, and they want to flip it to maybe $10,000, and before you know it, they will blow the account, right? So that is where the number comes in. So if you want to avoid taking too many risks, you need to have a large capital. With a large capital, you can be able to say to yourself, no matter how much I make, even if it's 5%, 2%, or 1% in a month, I am satisfied. And then you're going to risk little, like 1%. It doesn't matter if you come out unprofitable in a day. What matters is, are you profitable at the end of the month or not? So many traders make the mistake of thinking of daily instead of monthly. Like if they don't make profit within a day, they become angry and they will try everything they can to make profit. In fact, they will force profit on themselves. And that before you know it, they start taking excessive risk. Some will start making use of Matinga strategy. Let's say, for instance, you place a buy trade and you end up in a loss, right? And you place another trade, you end up in a loss, right? What you should do is just close trading for that day, right? And continue the next day. Maybe the market is going against you, or maybe your strategy is not working at that particular period of time. So the best thing you need to do is to close your chart off your laptop or your desktop and go and do other things. Then you can come back tomorrow and continue from where you stop. Maybe by tomorrow the market must have stabilized and the market must have been going in your direction, right? Maybe your strategy might work tomorrow. But some traders will want to force profit. When they lose, they will try. They will lose. They will try. Before you know it, they'll start doubling, in the sense of trying to recover their losses. And before you know it, they will just blow the account. You see, someone will buy a profit account today. Before 1 hour, they will just blow that profit account. That is why you need to understand that forex trading is not just about strategy. There is absolutely no holy grail in forex trading. I know you need a strategy because strategy helps you to have an edge, but most traders only focus their attentions on strategy. That is why you see them, they go on YouTube searching for strategy, searching for the holy grail, searching for the best trading strategy. But honestly speaking, there is no best trading strategy. What makes a consistent, profitable trader is the combination of a simple trading strategy, a good risk management, a good money management, a good risk-reward ratio, and the right psychology. That is what makes a consistent, profitable forex trader. So if you have these few things that I've listed, you are on your way to success as a forex trader. Forex trading is not a get-rich-quick business. So many traders think it is a get-rich-quick business. It is not. It's a business of compounding, right? It's a business of compounding where you risk lower to make higher. So when we talk of risk management, we're talking about how are you able to manage your trading capital. So if you are a newbie and you're watching this video, my candid advice for you is to take out your time to master risk management and psychology before you venture into trading, because this thing that I just listed is very important. Strategy is something that you can learn within few days or 1 week, but risk management and trading psychology takes time to develop. It has to do with your personality, your personal development, because the more you trade, the more you are developed. I wasn't like this when I first started. I didn't have this type of mindset when I first started. Before I started, I thought trading is a get rich quick because I see all these guys buying houses, buying cars on social media. I thought it was bed of roses, right? Not knowing that forex trading is not what you think it is. So I went into the market and I started gambling. I started using lot size that is bigger than me. And before you know it, I started blowing my account. I blew so many accounts before I decided to sit down and advise myself. In fact, forex sat me down and I started to advise myself. So I wouldn't want you to wait for forex to settle down, because when forex settle down, you will go through pain before you will be able to realize that you're making mistakes. So that is why you need to hear from an expert, someone that has been in this business for a long time. You need to take corrections from him, right? It is better you take corrections from other people's mistake rather than making the mistake yourself and taking correction from yourself, because taking correction from yourself will cost you so much money, but taking correction from others will not cost you anything. Others have already made the mistake, they have lost so much, so you are taking correction from them not to repeat the same mistake. But some traders will just say, this guy is talking bullshit, this guy is talking nonsense, give me strategy and let me go and make money. Honestly, you are just playing. Why I'm saying this is because there is absolutely no perfect strategy in forex trading. If you are doubting me, go and give it a try. Support and resistance is not the holy grail, because sometimes price can break above resistance or below support. So What matters in trading is the ability to accept losses. Some traders don't want to accept losses. When they lose, they will start multiplying their trading their trades. They start to multiply their trades. Let's say you are using one standard lot size and you lose. What you do is you go and multiply into 3 standard lot size, so that if you win, you recover the one you have lost. That is Matenga strategy. And before you know it, you just blow off your account, because the more you are multiplying, the more riskier you are, the more you are taking more risk, and before you know it, you just blow your account. So that is why it is always advisable, make use of only 1% or 2% of your trading capital. So if you are trading based on your capital, right? Let's say you have $10,000 as your trading capital. You are not trading with any prop firm, just your private capital. Then my advice is for you to use 1% of that $10,000. And so what is 1%? 1% is $100. So it is not left for you to calculate your lot size alongside with your stop loss, because what forms your risk management is your lot size and your stop loss. That forms your risk, right? So your stop loss tells you how many pips are you ready to risk per trade, right? So when you combine your stop loss and your lot size, it now amounts to the money that you are willing to risk per trade. Let's assume you have $10,000 as your trading capital and you want to risk at least 1% of that $10,000. So what you are going to do is you're going to calculate your stop loss, the amount of pips you're going to use for your stop loss. So if you want to use, like, let's say 20 pips for your stop loss, then you look for the lot size that when you combine it with your stop loss, it will give you $100. So you might use, let's say, 0.50 lot size, or you might use 1 standard lot size, depends. So it's not left for you to do the calculation, right? Do the calculation and know whether if the stop loss and the lot size is equivalent to 1%, which is $100 of your $10,000. So when you have done that, then you use the lot size with the stop loss. So let's assume the lot size is 1 standard lot size, while the stop loss is 20 pips. So what you are going to do is you're going to have at least 1 to 3 risk reward. So for the fact you are risking 20 pips as your stop loss, you should expect to aim for at least 60 pips for your take profit. So that will give you 1 to 3 risk reward ratio, which means you are risking $100 to make $300, right? So the consistency there is you continue repeating the same thing in each trade. So any trade you want to place, you must place 1 standard lot size and 20 pips stop loss, and your take profit must be 1 to 3, which is 60 pips, right? So that even if you lose, right, even if you lose 3 times, just 1 win will recover your losses. Then you maintain this money management strategy. You maintain it and have a consistent trading strategy. So when you have mastered a good money management skill, because this will help you in your psychology, then you now look for a simple trading strategy depending on the type of trader you want to be. If you want to be a trader that trade based on support and resistance, or you want to be a trader that trade based on moving average. So it depends on the kind of trader you want to be. So you pick a simple trading strategy that has an edge and combine it with your money management. So what you do is you become consistent. If your strategy is based on crossover, what you have to do is to exercise patience and wait for a crossover. So whenever a crossover occurs, you simply place a trade, maintaining the same risk management. So this is what we call the consistency in trading. You repeat the same thing over and over and over again. That is the consistency we are talking about. So once you have the right money management skill, it's going to help your psychology. So whenever you place a trade, you're not going to panic. You're going to exercise patience. wait for your take profit to be triggered. So the price either hits your stop loss or your take profit because you have already accepted the risk, right? So you are not panicking, you are not scared because you are risking just 1% or 2% of your entire capital. So it will take you like 100 times or 50 times for you to lose your entire capital. So losing one trade is not going to affect your account. Losing two trades is not going to affect your account because you have so many opportunities. So once you have a good risk management and money management, it's going to help your psychology. You're not going to panic. It's only those that risk 50% of their capital. These are the people that will be panicking. When they place a trade, they will be scared. Before you know, they will just close their trade. So these are the people that hold on to their losses and close their winning because they are trading based on emotion. So if the market is going against them, instead of them to close, they will just leave the trade, hoping that the price will reverse back into their direction. To their greatest disappointment, the price will keep on going against them, and before you know it, they will blow their account. And if the price is going in that direction, they become scared. They become scared that the price might reverse against them, and when the price goes like 10 pips, they will close the trade, and before they will know it, the price will go 100 pips, and they'll start regretting. So these kinds of traders are trading based on emotion. So if you don't have the right money management strategy, it's going to affect your emotion and your psychology. So that is why I keep saying that money management still remains the key to successful forex trading. So if you truly want to become a consistent, profitable forex trader, you need to work on your risk management and money management. You need to treat forex trading like a business. Don't treat it like a gambling. Treat it like a business, right? And you are going to last long if you sincerely treat forex trading like a business. So my advice for you guys is to go home and work on yourself, work on your emotion, work on your psychology, and work on your money management and risk management. Make up your mind and build a trading plan. Which lot size do you want to be using per trade? Write it down. How many pips are you going to be risking as stop loss? Write it down. How many pips are you going to be placing as your take profit? Write it down. Once you have done this, it will help you to remain consistent. So you have a focused trading strategy. So you have a focused trading plan. So your stop loss will always remain 20 pips and your take profit will always remain 60 pips. So you have built consistency, and then your strategy might be moving average crossover or the use of support and resistance, and you keep on using the same strategy over and over again, whether if you're in losses or you are winning. So what matters is your edge. As long as you have a good risk reward ratio, right, you have the better chances of coming out profitable before the end of the month. So you don't check your result on a daily basis, you check your result based on monthly basis. You might make losses during the day, the next day you might recover your losses and still make profit. So you don't judge your strategy based on daily performance, you judge it based on monthly performance. So you need to start treating your trading as a business. So this is the only way you can succeed in this business. So ladies and gentlemen, that is all I have for you in today's video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I publish new content. I will see you again in my next update. Enjoy the rest of your day. Bye.